Hello there, welcome to Market Call. Stan Wong is our guest. He's portfolio manager at Scotia Wealth Management. He'll be taking your questions on North American large caps and ETFs. Call us toll free, 1-855-326-6266. Or send an email. We love to get the emails to marketcall@bnnbloomberg.ca. Stan, thanks very much for joining us.
Great to be here. Thank you.
I guess we should put an asterisk on any comments right now, pending what happens with this trade war.
Sure, and I was going to say, what a year it's been last week, right? So, lots of volatility out there. But we've seen this before. I mean, right now we can't call it a bear market. We can't call it a bull market. It's more like a kangaroo market with all the bouncing around for sure. But look, we've been there before. Uncertainty breeds volatility. But for long-term investors, volatility creates opportunities. And we see that at this stage. We don't know where the bottom is. I don't think anybody really knows where that bottom is. But I think if you are investing for the long term or for 12 months or 18 months or 24 months, I think investors will be pretty pleased with making that decision today. We saw that in 2008, where we saw very deep losses from the financial crisis. We saw that in 2018 during the U.S.-China trade war. Market dropped almost 20% in the fourth quarter, went up over 30% in 2019. And then, of course, 2020, COVID crash. We ended up the year at all-time highs. So we've seen this movie before. I think it's all about patience, not panic. That's what's going to help in the long run.
Kangaroo, I was in Australia. I was at a petting zoo, and there were kangaroos up close. I hadn't realized how weird they are because they evolved over millions of years separately from us. They're very strange up close. In any case, let's get back to the stock market. And Canada, of course, we're going to catch a cold if America gets economic pneumonia. There's no doubt, or the other way around. Do you see Canadian stocks as something of a refuge, though?
Our portfolios are a little bit more weighted towards the U.S., quite honestly. We're looking at international markets for its valuation discount as well. But quite honestly, we have more of our weighting in the United States at this point. I think without talking about tariffs and all that sort of thing, there's much more depth and much more choice in the United States, as we know. And I think that the economy is very resilient in the U.S. We're seeing inflation numbers come down a little bit, which is good news in my opinion. Unemployment is still near multi-decade lows. And the consumer is very, very strong. As you know, the consumer is 70% of U.S. GDP. And as long as that consumer remains strong, I think that will continue to help the market. Of course, tariffs are going to affect the consumer, but we have to look, again, 6-12 months out. Are the tariffs, the way they look like today, going to look like what they are in 6-12 months? What it will look like a week ago changed just 5-6 days later. And the other thing to consider is that we have U.S. midterm elections coming out next year. So the trade stance could soften. It already softened in the past week or yesterday. We can see fiscal support from the government in the U.S. And then, of course, we may see more deregulation and more tax cuts, which will help the economy.
Right. And apparently pressure from Wall Street and business leaders via Scott Bessent, partly on the Treasury Secretary, got Trump to cool his jets on these tariffs.
Yes. And again, going back to the sentiment has been so tough. The VIX went up above 45. In fact, it hit 60. You look at the stats. Typically, when you go over 45 on the VIX, going back to 1980, the 12-month return for the S&P is 37%.
Give us that again. When the VIX does
When the VIX is above 45, going back to 1980, the 12-month return for the S&P 500, on average, is 37%. It hit 60 last week.
Wow. So it's a pretty good indicator there. When
it's a great contrarian indicator, and it's worth 100% of the times.
Okay. Of course, you never know. This could be the exception. But,
it could be.
Yeah. Stan, it's great having you here. Thanks very much. Stan Wong, portfolio manager at Scotia Wealth Management. The topic today, North American large caps and ETFs. We have an email from Game in North Bay, Ontario. What do you think of Walmart? Is it a buy now? Should I wait for it to settle?
Thanks for that question. So Walmart's a name that's not in our portfolio. We recently held Costco for a number of years, and we actually sold out of Costco for a very similar reason why I would probably not want to buy Walmart today in our portfolios. Valuation is what I would be concerned with. Of course, consumer staples and other defensive areas like utilities and so forth and healthcare have done very well throughout this market volatility. But when you look at Walmart, it's trading at 34 times forward earnings with a 7% growth rate. So the PEG ratio is right up there. It's 5 times, which was kind of where Costco was when we sold it. And going back, it's about 7% earnings growth. So nothing's changing. Going forward, we expect 7% earnings growth. Going backwards 5 years, 7% earnings growth. It is trading at the 200-day moving average, so there could be a little bit support level there from a trading perspective. It could bounce if the markets kind of recover a bit. Although it is again a consumer staple name, and they'll probably be very defensive, and its beta is pretty low. They'll do well in a economic downturn. Groceries and essentials is such a big part of Walmart's inventory, so their revenue will remain very steady. Their e-commerce is improving as well. But again, the valuation makes it tough for me. And also, of course, you've got intense competition from Amazon and other traditional retailers now.
Right. So, yeah, I'm just looking here at the 200-day moving average. It looks like it did just breach it, but it's above that now. It breached a little while ago. So it is it looks to me like it's bounced off the 200-day moving average.
Yeah,
is that a good sign? Sorry.
It is a good technical sign, but obviously there's other things to look at, such as the fundamentals, which would keep me away from buying that. Just like same reasons why we sold Costco not too long ago.
Oh, okay. Just the price, the valuation.
Valuations, exactly.
Okay. Ray is in Pickering, Ontario. Go ahead, Ray, please.
Oh, good day, guys. My question for Stan is, I'm looking to purchase some type of monthly income ETF, and the turmoil in the markets right now, it might be a good time to look at something like this. I'm just wondering if Stan could recommend something, if it would be more of a Canadian-based dividend type of ETF or North American. I'm kind of familiar with, been looking at something like a VDY from Vanguard, or there's an XEI, I think, at BlackRock.
Okay. Thank you very much.
Well, thanks for the question. I think he just answered his own question. But yes, VDY would be a great example of a Canadian ETF with Canadian names. XEI would be another name that you can consider. They're both around the 4.9 to 5.3% dividend yield today. VDY does have a bit more of the banking exposure, so it depends on how much concentration you want in those Canadian banks. One other idea I would present would be in the U.S. would be HDV, which is another iShares strategy, and the Vanguard Dividend Appreciation Strategy, or ETF. That's another name that you can consider. That symbol is VIG in the U.S. So HDV in the U.S., VIG in the U.S. Those are a couple of examples of U.S. names you can consider if you're looking for something beyond XEI and VDY in Canada.
Right. And broadly, are dividend ETFs a decent idea, or would you recommend just holding a bunch of high dividend paying stocks?
I think it really just depends on the investor. If the investor requires the income, then dividend ETFs makes a lot of sense.
Yeah.
However, in some cases, you may be looking for a bit more growth. So you might be looking for more of a quality factor ETF or a momentum or a growth factor ETF, whereby the dividend is a little bit less, or if anything, but you might get a more of a total return or capital appreciation.
Right. The yield right now on VDY is apparently about 4%. Okay, thanks for that question. Glenn, can I get Stan's views on Shopify? Yeah, well, that's a kangaroo stock, super volatile.
It certainly is. So, valuation is 61 times forward earnings with a 25% growth rate. So you're still looking at well over 2 times PEG ratio, PE to growth. Last 5 years, it grew about 24% EPS growth, so similar to what we expect going forward. But the 200-week moving average is trending lower, which is not a fantastic technical sign. Yes, revenue growth remains to be pretty strong at about 25% going backwards. but you got to watch out for rivals like Amazon and Etsy and so forth. And the other thing I'd say about Shopify is that it's more so than others, more dependent on smaller and maybe mid-sized businesses, which in turn, those companies can be affected by an economic downturn.
Right. So just looking, yeah, it looks like it has gone, in the US trading anyway, it's gone below the old 200-day moving average right now. Okay, so wary on Shopify. We're going to be right back with Stan Wong, and he's taking your questions on North American large caps and ETFs. We have an email from Teresa. Please provide your assessment of Adobe.
Thank you for that question. So Adobe is not a name we hold today in our portfolio. We've held it in the past. Shares are trading at around 17 times forward earnings with about a 14% growth rate. So from that perspective, compared to other tech names, certainly not a bad valuation. However, they did issue some tepid guidance going forward, which has made the stock come down. It is now trading below the 200-week moving average, so technically not a great sign. And that
200-day moving average, sorry.
The 200-week.
Oh, 200-week. Oh, I'm sorry.
The longer term, which is even more pronounced when you look at sort of trends, is moving lower. That actually is moving down. That 200-week moving average is moving lower as well. Oh. So valuations are fine, but we often will look at the technicals to make sure that lines up. And the technicals for me don't really line up. It is below the 200-day, below the 200-week, and that 200-week moving lower is a little bit of a troubling sign. I note also that from sort of all-time highs, it's down about 41% today.
Yeah, I think the concern has been they're going to face a lot of competition in AI, graphics, etc.
A lot of competition, and when you look at this chart, you see this trend since last year of falling lower lows and lower highs.
So it looks like with some of these tools, you can cheaply just do stuff yourself. You don't need Adobe software.
Yeah, you can, and obviously they'll evolve and bring more AI into the business and so forth. So we'll see kind of what happens at that point.
I see stuff on Twitter sometimes, fake stuff, and I think, oh, that's cool, but I'm not going to retweet that because I think we're into a scary world. Jim in Elliott Lake, Ontario, go ahead, please.
Good afternoon, guys. Stan, just your thoughts on Suncor Energy. I know it's been beat up. The whole sector has. Are you participating there these days? If not, are you? What would be like a catalyst maybe for you to kind of get into some of these Canadian energy stocks?
Suncor.
Yeah, thanks for that question. So Suncor is a name that we've retained in the portfolio. We have sold off a bunch of energy names for the time being. Obviously, concerns about the potential for a recession or a global recession is hitting energy names at this point. I'm in the camp that I think that, for me, a recession is still too premature to think about that. Is it possible? Sure, but a recession is possible at any point. And I believe that the way the tariffs look today is not what it's going to seem 6 months later or 12 months later. But who knows? You're getting a 5% dividend yield from Suncor, which is a good dividend. Again, we held other energy names and decided to retain Suncor. With a 200-day and 200-week moving averages still moving higher, that's a good sign. And on the 200-week moving average, which is a very important indicator, it's right at the 200-week support levels today. So if you own this name, I wouldn't sell it, in my opinion. And if you're thinking of buying it, this could be a point in which you might want to look at it, just given the fact that we're right at the 200-week, and 200-week is massive long-term support levels for most stocks, or can be support level, I should say that. And oil prices are cheap. Will they get cheaper? It could, but it can turn around quite quickly if we see that, hey, there's no recession, or things can turn around.
Yeah. And they have been increasing the dividend pretty regularly, it looks like. Thanks very much. Let's go to the phones. Len, fire ahead, please.
Yes, thanks for taking my call, guys. My question is on Flutter Entertainment. I've owned it since it was a Maya Gaming. It was doing very well. Of course, it's dropped lately, and I'm wondering if there is a recession, will it affect a gaming stock like that? Thanks, guys.
So it's a big online gaming and gambling and iGaming stock as well.
Yeah, so sports gaming, sports gambling, that type of thing. Very similar to like a DraftKings or that type of name. Mm-hmm. It's a good question. I mean, what happens in a world whereby there's a slowdown with the consumer? Will they spend a little bit less on online gaming? Mm-hmm. Probably. With that being said, I wonder how inelastic that world is. I think it's somewhat inelastic in that people will continue to do that. When you look at the shares, I mean, you've seen a bit of ups and downs with the share price. Right now, when you look at Flutter, it's dropped below the 200-day moving average, but it's now sort of picked that back up. But the averages in terms of how the stock looks is not too bad from a technical perspective. It has actually done okay over a 200-week moving average. The 200-week is moving higher. But of course, you'll find lots of volatility with this type of name. Valuations in this space, whether you look at Flutter or you look at DraftKings, is not necessarily cheap. But you're not going to buy this stock based on valuations. You're really buying it based on the growth of the industry, the growth of online gaming and so forth. And with Flutter, we see a 33% growth rate going forward. So definitely a higher beta name. Put it in a small pocket of your portfolio, if anything. Online gaming, I think, is a growing industry, in my opinion. And hence the growth expectations for this.
So it's dropped a lot since mid-February, but it's still up about 15% in the past year. Yeah, we were having trouble with the chart there. Dominic's in Montreal. Go ahead, please.
Yes, hello. Thank you for taking my call.
Pleasure.
I'm calling on the Vanguard S&P 500 VOO, and I wonder if Stan can confirm the current PE ratio of the S&P 500. Is it at about 20 now? Do you consider the PE ratio a good way of valuing the S&P 500? And at what PE ratio would you say is a really good buy into the S&P 500? Stan, thank you.
So,
from a trailing perspective, the PE is 23, and on a forward basis, it's below 20 at 19. With that being said, there are many studies that show that a PE level is not a really great determinant of an index or an investment's return going forward. And you can see that graph. It can be anywhere. You can have a 7 PE and the investment or the index goes down. You can have a 25 PE and next year later you're going to have good returns. So the PE is not really a great short-term determinant of returns going forward. What's more important, in my opinion, is earnings growth. And right now we still see high single-digit, low double-digit earnings growth for the S&P 500. With that being said, the S&P 500 is a bit of a very concentrated index, as you know. Top 10 names is 30% of the index. Technology with communications with consumer discretionary is close to 50% of the index. But, those three sectors have been the worst performing sectors, at least, checking out a few days ago, so far this year. So you do have concentration risk when you just buy the market cap index with the S&P 500. And today, later on, we'll chat about an index that's related to the U.S., but it's not concentrated in those areas. So, checking the numbers here, communications, technology, and consumer discretionary, those are so far this year to date, the worst performing sectors. So of course, if you own the S&P 500 market weight, you're going to have close to 50% in those three sectors. So, not a great diversified strategy. And because of that, the valuations might be a bit higher. When you look at it, I shouldn't give away what the top pick is.
Okay.
We'll talk about the top pick later for a different idea.
Okay, we're going to check out Stan's past picks right after this. Stan was on our show March 26th of last year. His first idea was a Dollarama. Now, of course, we should note that the markets have been in turmoil over the past couple of weeks, to put it mildly, but Dollarama up almost 50%.
Yeah, we continue to hold this, and this is the only name out of the three that we continue to hold.
Okay.
So Dollarama, we continue to love the stock. It's at you're paying 34 times forward earnings for it, so a bit pricier, but you're getting 15% earnings growth from the name going forward. We think that it's in a very dominant position in the Canadian discount retail industry. You think about the consumer in Canada being very cost conscious, especially with what's happened with inflation, the cumulative effects of inflation over the years. There's going to be more and more looking for this cost conscious type of shopping. And when you look at sort of their business model, very recession resilient. They can sort of change their inventory into different types of goods that will meet the current economic environment. And what's interesting is that I looked at how Dollarama has performed since its IPO in 2009 versus the TSX. It has had a total return of over 5,500%.
Wow.
TSX 245%. So pretty phenomenal return since its IPO in 2009.
Okay, that is truly amazing. What did you say, 5,000% since the IPO?
5,500.
Oh, my goodness. Okay. Let's get on to your next idea. Novo Nordisk, the big diet drug and diabetes drug player. The bloom has come off the rose with some of these names right now.
Yes, specifically Novo Nordisk. So we're out of the name. We were out of it several months now. The valuation's actually become relatively attractive at 16 times forward earnings with a 14-15% growth rate. So from a valuation perspective, it looks attractive. But you're right. I mean, the stock has now fallen below its 200-week moving average, which is troublesome. I think long-term, it's a name that we can consider once again once things turn around. And what's happened with Novo Nordisk is partly because of supply and efficacy reasons. They're losing a little bit of their market share in the weight loss and diabetes market to Eli Lilly, which we continue to hold in our portfolios. Overall, this GLP-1 market will continue to expand long-term through demand, greater demand from consumers, and also this expanding market potential because they're continually finding other things that GLP-1 can treat, such as heart disease, kidney disease, and even addiction as well. So I think long-term, the market is growing, the demand for this type of drug is growing, but Novo Nordisk, more short-term, has gotten into some issues with supply chain and also just losing some market share to Eli Lilly because of efficacy.
Okay, so you're out of this name at this point.
We're out of this name at this point, but we still hold Eli Lilly.
Okay, and finally, a giant in cybersecurity. There was a stock split late last year. Palo Alto Networks, a total return of about 18%.
So we're out of this name, sold it again several months ago, took our profits. I really think that cybersecurity is one of these mega trends long term because there is simply rising cybersecurity threats around the world. It's hitting enterprise, government, and also businesses. And it's going to cost you more not to spend money on cybersecurity. Now, of course, you're going to have cyclical areas where companies just don't want to spend because of the environment, the economic environment, but they're going to have to go back to continually increase their cybersecurity spending. When you look at this name, it is a bit expensive. Part of the reason why we sold it at 50 times forward earnings with a 13% growth rate. That growth rate's kind of come down a little bit compared to the last 5 years, simply because of company expenditures out there in terms of guidance, in terms of what they're spending on things like cybersecurity. But long term, great channel of higher highs and higher lows. It's a name that we like. Just we want to see a little bit of a cheaper sort of space. And there are two other names that we've also been in and out of, including CrowdStrike and Fortinet, which are the other couple of major cybersecurity companies. Okay,
well, two of your picks certainly beat the markets. I'm showing the TSX up about a total return 7% in the past since April 26th of last year, and I'm showing the S&P total return of about 3%. So two of your picks were ahead there. Okay, we're going to take a break. Stan Wong is our guest. Stan is portfolio manager at Scotia Wealth Management, answering your questions on North American large caps and ETFs. You know that number, 1-855-326-6266. Let's have a quick look at the markets before we go back to the calls for Stan Wong. Oh, not much joy there. You can see the Nasdaq has been weakening. It's stabilized over the past while, but now down more than 6%, giving up a lot of the gains from yesterday. Let's have a look at some of the other big indices here. S&P 500, pretty similar, near the lows of the day. So it's an ugly situation. And the S&P 500 down more than 5%. And let's have a very quick look at our market. The TSX down around 4%. I'm just looking at the NASDAQ here. Maybe we could just throw up a very quick 1 week chart for the NASDAQ. It is still up. There's an intraday. I'm not sure if we have a 1 week. The NASDAQ is still up from its closing level on Tuesday, but it has given up quite a few of the gains posted yesterday in the big market rally. Right, Ray is standing by in Kingston, Ontario. Ray, go ahead, please.
Hi, I'm calling to find out if Stan would be a buyer of MasterCard right now. I know that all depends on how the market's going to do in the next week or 2 weeks or month, but it's at 491. And would he step in? Its P ratio is still high. It's 35 and change. So would he be stepping in, or does he see a lower entry point based on its moving average? Thank you.
Thank you.
Thanks for that question. So MasterCard is a name in our portfolio alongside of Visa. With regards to the PE ratio, you're paying about 31 times forward PE at this point. And I think that PE ratio is always going to be a bit of a premium because they are in a space in which there's very few competitors. Again, Visa, and then you talk about Capital One and Amex, which are a little bit different regardless. I like the name. I would say that the stock is, near oversold at this point, slightly below the 200-day moving average at this point, but that's okay. A little bit of being below that's fine. This 200-day moving average is still trending higher, and then more importantly, the 200-week moving average is trending higher. So long-term, this name is fine. Very difficult to say, hey, is MasterCard going to be cheaper or more expensive, 5% or 10% a week later? Right now, the market is not trading on fundamentals, it's trading on news. All I can say is that when we're purchasing these names, we're looking 12 months, 18, 24 months out. And I think we'd be happy that way to get some of these names at a discount because MasterCard is now still about 16% below its recent highs. It was 20% lower. Now it's about 16% lower. So I do like the name. Certainly if there is an economic slowdown that's going to affect the consumer. But again, as I said earlier, will the tariffs look like they do today, 12 months out or 6 months out or even next week? Who knows?
Right. Okay. So it's a reasonable choice then, MasterCard, or what do you think?
I own it. I like it.
Sure,
we continue to buy it alongside with Visa. So I like this space. Obviously, the consumer is important here, but we also see more cross-border spending. More recently, I know that some Canadians aren't going to the U.S. because of the dollar and so forth. But that cross-border margins are very high, and we are seeing a bit more of that from different borders that are happening. Americans going to other areas and so forth.
Apparently, Canadian car trips to the U.S. are way down.
Well, I'm heading down there next Tuesday, so I'll be glad not to have to line up.
Where are you off to?
We're gonna catch the Sabres game against the Toronto Maple Leafs
in Buffalo.
In Buffalo,
nice.
Yeah, we'll save a few dollars versus going to the game in Toronto.
Oh yeah. It's much more reasonable. Yeah. Will you go to the art gallery in Buffalo? Will you have time?
Probably won't have the time. Yeah.
Oh, it's incredible. Yeah, they did a big reno there. Okay, thanks for the question. Nick is in Montreal. Go ahead, please.
Good afternoon. Thank you for taking my call.
Pleasure.
I'm calling with regards to Alphabet. I would just like to know would you start a position today, or would you? I know it's the same like MasterCard, or would you wait? So I'll just listen to your feedback. Thank you. Bye.
Thanks.
So Alphabet is a name in our portfolio. We highlight it as one of our tech names, and we are underweight technology. So I think that there's several names out there in the tech space that continue to make sense, that have that strength and that scale, and Alphabet certainly is one of those. I do note that Alphabet is now trading close to the 200-week moving average, which is a very important long-term support, and if it bounces off of there, I think it'll do very well. You're getting about 12% earnings growth going forward. You're paying about 17 times earnings, which is not really expensive for a name like Alphabet. Clearly, they're the giant in search, but they're also in the cloud business. That business is growing very quickly in the hardware space, whether it be the phones or the watches or anything along those lines. It's just a growing business, and I think long-term, it's a name that will continue to make sense. I just don't see a scenario in the near future whereby Google is overshadowed by somebody else.
What about AI, though? People coming up with better ways to search?
Yeah, that's a great comment. So I think that with Gemini and the other areas in which they're trying to monetize AI, it's still very early stages, right? Because Apple's in it, Microsoft's in it with Copilot and ChatGPT. It's still very, very early stages. I think just being able to add those types of areas, this regenerative AI, into their models will improve their prospects, improve their productivity, and improve their consumption.
Apparently, the AI is running out of data on the internet now. It's got so big. So they're trying to work out ways that it can learn. Yeah. The internet, vast as it is, it's run out of data. David is standing by in Edmonton. Go ahead, please.
Hey, Stan. I'm just wondering about your outlook for gold, whether you see this 3,200 level sustainable, and then possibly could you recommend any Canadian ETFs or more global ETFs that maybe we could take advantage of?
Gold ETFs, okay.
Yeah, thanks for that question. So I'm not a big buyer of gold investments or gold ETFs or, the miners or the commodity itself. Our models really look for intrinsic value. So as you know, gold itself does not have a dividend, it doesn't have a cash flow, it doesn't have a revenue flow. So difficult to add that in our portfolio. Certainly gold has done extremely well in the past little while, in the past year or so. So gold has done extremely strong, great returns, just as we've seen Bitcoin do very well, which also does not have much in terms of intrinsic value. So gold's a space that I tend to sort of stay out of. With that being said, like XGD from iShares would be probably your most major
the Toronto
ETF. I think Van Eck GDX is another major one out there. But I think just with gold, I think there's a lot of excitement with what's happening with gold more recently. But you look back at history. Going back to the 80s, it fell 61% into 2000 over 82 quarters. So before taking 26 quarters to return back to where it started. So gold itself, the commodity, can be very, very volatile. So obviously volatility up is great, but it's had moments of very tough volatility. In fact, going back just a little bit more into recent history, gold fell 42% from 2011 to 2015, so just over a matter of few years. And that was a 52-month experience, and it took 55 months just to get back to even. So gold just tends not to be a major part or any part of my portfolio. I know there's gold bugs out there and people like gold, and it certainly has done well, but it just doesn't fit in our portfolios.
I guess there is a constituency that says you should have maybe 5% because it moves differently from stocks.
Absolutely, and I just wonder now that we have cryptocurrency, how does that fit in with that that percentage in there? And I wonder if they kind of do the same thing in some respects.
Okay, Stan Wong is our guest. He's taking your questions on North American large caps and ETFs. Let's have another look at the markets intraday. And we have seen a slight rally off the bottom. So the NASDAQ, it was down a few minutes ago, more than 6%. Now down about 5.7. Let's have a look at the intraday S&P, see are things getting any better? Similar pattern, bouncing off the bottom, as they say, but we're still down almost 5% on that broad US benchmark. And finally, let's have a look at the TSX. We are suffering a little bit less in Toronto today, but with the weakness in the oil price, we did see oil dipping below $60 again this morning. So it's hard for Toronto stocks to rally. Latest price I have for you on oil is about $59.40 US a barrel. Let's go to an email from Susan. Can you tell me the benefits and drawbacks of XLF, which is a TSX-listed financial company ETF, versus an ETF that's focused on the American banks, the big American banks?
Sure. This is actually listed on the U.S. exchange. It's XLF is the U.S. banks.
Oh, it's the U.S. one. I'm sorry.
No
okay.
problem. Yeah. So, top holdings would include Berkshire Hathaway, J.P. Morgan, Visa, MasterCard. And I do like the financial sector in the U.S. I think it's one of our top sectors. In our opinion, on a go-forward basis, have been doing very well up until more recently, given the tariff situation. 200-week moving average has started to turn upwards, and the 200-day moving average has been trending higher as well. So I think that when you look at beyond tariffs and you look at potential for deregulation and tax cuts, this will benefit some of the players inside the XLF strategy, such as the major banks and such as Goldman Sachs and so forth. So I do like this space. You can certainly look at individual names, which we do look at as well. But this is a great way to grab all the names in there, including Warren Buffett's Berkshire Hathaway.
So XLF is the SPDR financial ETF in the United States, and then Financial Select SPDR, and then the TSX one I got mixed up. It's XFN.
Right.
And that's been doing okay, total return of 12% in the past year anyway.
Yeah, and I think the Canadian financials are pretty solid, certainly cheap as well. With XLF, the MER, the expense ratio is only 8 basis points. So going back to whether or not you want to choose individual names or not, depends on the size of your position in the portfolio.
Right, okay. We have an email from Chris. Can you please provide your insight on Palantir Technologies?
So, one of these previous high flyers, and it has done quite well over time. Stock is down about 33% or 33% from recent highs. So certainly, a high beta type of stock, but also valuations are quite up there as well. I would say that this particular name, you got to be careful. It's, again, valuations are stretched at this point. Let me just pull up some of the numbers here. You're looking at 50 times forward earnings. Sorry, I read that wrong. 152 times forward earnings with a 31% growth rate. So that growth rate is attractive, but 152 times would be challenging. Certainly, I understand the aura of this name, given the fact that they're in the AI space and so forth.
Defense.
In the defense area, which is probably a very inelastic sort of demand type of area. But just the valuations are, for our models, just a bit extended.
Okay, stock's actually held up pretty well. It's up about 13% this year, but way down from February, from its record high. Okay, we're going to get Stan's top picks next. Tomorrow on Market Call, our guest is Mike Philbrick. He's CEO of Resolve Asset Management, and he'll take your questions on exchange-traded funds. Now, if you missed a Market Call, as if that would ever happen, check out our daily podcast. It's on iHeartRadio and other podcast platforms. And, of course, you can watch full episodes on our YouTube channel. First idea, Apple.
Yeah, such a dominant tech leader, but it's a stock that's just been beaten up so badly. It's down. It was down as much as 35%, still down about 30% from recent highs. You talk about Apple, you think about the iconic brand, you think about strong cash flow, and you think about a very loyal global customer base. And we look at 2025 projected revenues over $408 billion. So just a giant out there.
Wow.
And the shares are down so much due to the tariff concerns and softer hardware demand. But when you look at the services segment, that growth is very high margin. It's expanding. You see a very stable revenue stream. And that's going to cushion all these near-term uncertainties, in my opinion. I think Apple has pricing power advantage because they can absorb or pass on some of these tariff-related costs that may or may not occur over the next little while. Somebody who has their phone, their iPhone that's a couple years old and the battery's starting to die a bit, they're not going to switch to another phone. They're going to buy the next Apple phone, and it could be a couple $100 more, and they'll be fine with that from what I can see. And when it comes to production, they're actively diversifying their production outside of China, or they're looking to do more of that. AI, wearables, and health technology is kind of the growthier areas that are part of Apple. The shares are trading right at the 200-week moving average. That is long-term support for a lot of these great quality companies long-term. So I think potentially pretty good medium and long-term entry point. Obviously, solid balance sheet. They can buy a lot of countries out there with their cash flow. They have a very disciplined capital return program with dividends and also, share buybacks and so forth. And we see very steady 15% earnings growth going forward. So, yeah, the shares are, beaten up in the last little while, but I think there's a bit of an opportunity to accumulate a very iconic technology name.
I'm showing them down about 28% from Boxing Day, which I believe was their record high close. So you think investors are missing the value here?
Yeah, there's concerns obviously about hardware and so forth, hardware demand and so forth, but I think that's overdone.
Right. Expedia, huge name in travel. You're not worried about people with a recession, perhaps, not traveling?
Yeah, this was an interesting name yesterday. This name jumped, I think, 20% yesterday based on, the tariff news and not so punitive tariffs all of a sudden. This is a leader in this space, this leading travel online platform. They own, obviously, Expedia.com, Hotels.com, Hotwire, and Verbal as well, which attracts, more affluent type of travelers. They've got a very key part of the industry with online travel and booking. We're looking at about $14.5 billion fiscal revenues forecasted for 2025. Travel's resilient, I think, especially after the pandemic. You're seeing strength across lodging, flights, and vacation packages together. And I think long-term demographic trends, as sort of you see a bit of a more aging population, people going into retirement, you're going to see more travel. And then you look at some of the arrangements today after COVID, there's more work from home. Well, some people are work from Bermuda. Yeah. So we're seeing a little bit of that as well. So certainly a leadership name in this space. Shares were down as much as 37% from recent highs. Wow. I think that's overdone. Also near a 200-week moving average, a very high quality name. And again, I think long-term demographics makes a lot of sense, whether it be, travelers from Asia, travelers from North America. Earnings growth is projected to be 20% on a forward basis. We've got strong cash flow. It's not a Royal Caribbean or a Carnival Cruise Lines. They don't have to worry about capital expenditures. They're an online platform. So I think combined with a lot of post-pandemic tailwinds, that this name will continue to do well.
And then you've got an index call here, Invesco S&P 500 Equal Weight Index ETF, EQL.
Yeah, so we talked earlier about the S&P 500 index, which is a market-weighted index, whereby you have a big chunk of the index in 10 names, and then almost 50% of the index in tech, communications, and consumer discretionary, which we can argue a lot of that is actually just, we think of technology, because 50% of consumer discretionary is Amazon and Tesla. We think of that as tech. And communications, as you know, has Google and Facebook and so forth. So this one is an equal weight strategy across all 500 constituents within the S&P 500. It basically mitigates that concentration risk amongst the top 10 that you normally see in the S&P 500 market weight index. It'll take you a little bit away from the mega cap stocks. It'll still give you that exposure, but it'll take you away from that. It'll give you broader sector participation, and you'll get more industrials, financials, and consumer staples than the S&P 500 market weight index. It was down as much as 17% from recent highs, down to the 200-week moving average as well. So I think long-term, I don't think you can ever invest against the American economy, because that is a powerhouse of the world, and it's the strongest and the biggest in the world, and very resilient. You go back again to 2008, you go back to 2018, and then, of course, COVID. We all came out of those things very strong. And I think that adding this type of exposure on an equal weight basis makes a lot of sense. MER is 26 basis points. There's also a US dollar version, if you like, from Invesco, and also a hedge version as well that Invesco offers.
Right. I'm just comparing the S&P Equal Weight Index with the S&P 500, and certainly it has this year been outperforming that strategy, down as of this is as of this morning, not counting today's market rebound. As of last night, I mean, down 6%, whereas the S&P 500 was down 7%. So it's held up slightly better.
What's interesting is that if you go back 25 years, the equal weight index has outperformed the market weight index.
Wow.
And there are periods of time which you've had a stretch whereby the equal weight did very well. It's really only the last 10 years or so in which these mega caps have kind of come in. It's been such a thematic place to be that the market weight has done well.
We've got to leave it there, Stan. Thank you very much. Let's have a very quick look intraday at the S&P 500 and the TSX before we go. We're going to be right back, actually, with trading day after this. And you can see slight bounce off the bottom for U.S. stocks, but they are still down more than 4% today. Not sure if we have time to have a quick look at the TSX here. Remember, oil has been under pressure, and the TSX still down almost 800 points. Thanks very much, and trading day is up next.